Let us begin. My name is Darren Joseph, HJ.Tax. We're a team of cross-border tax advisors that seek to demystify the sometimes confusing world of international tax for those of us who are trying to live that international lifestyle. Today, we have the honor and the privilege of speaking to the one, the only, Mr. William Funk. Bill, would you like to introduce yourself?
Thank you. Again, my name is William Funk. I'm a tax attorney, member of the firm Norris McLaughlin, and I do. I have a fairly broad tax practice, which covers such things as cross-border, tax planning for corporate transactions, as well as partnerships, personal matters, state and local, and I also deal with civil tax controversy. So it's a fairly broad tax practice.
So, FBARs. So, question 19. Could you talk to us about FBARs?
Well, the basic rule of FBARs is that that if anybody has foreign bank accounts that at any time during the year have exceeded, and this is on a cumulative basis, so it can be three accounts together, but exceeded $10,000, that there's a required filing. And again, this is an information filing. It didn't even originate under the Internal Revenue Code. It originated something called the Bank Secrecy Act. But over the course of time, the enforcement has been transferred over to the I.R.S. And there's a whole history to it that sort of starting with originally there's concerns about terrorism, and then then some of the foreign some of the foreign planning that went on at UBS, that came to light around the time of the, had to come to light at the same time as the whole Lehman debacle. But that the upshot of which is that the enforcement came over to the I.R.S. and so that there are these penalties which can be can be 10,000 per year for non-willful filings, for non-willful failures to file, and that can become even larger for failures that are not non-willful. Again, it happens that there are ways to fix non-willful, that there are various types of delinquent disclosure programs that are available. Again, the thing that that doesn't pass muster, is where that you're aware of the requirements, but thought, well, it couldn't have been that important. That this is not something anybody had interest in. It was none of their business. That even though that it doesn't feel like a willful filing, willful failure, that's a willful failure. So,
I mean, that's an important point, that it's just a reporting requirement, but it is super important. And, in other countries, like I have a client in the Middle East that was saying, it's part of their culture to have joint accounts with parents and stuff like that. Basically, every account over which you have signature authority, even if you're not the ultimate beneficial owner and it's for your mom or your dad or some other relative that for some reason they couldn't get an account on their own, whatever the reason is, once you can sign for it, it's reportable, including company accounts. So maybe you're senior enough in your company, the company that you're involved in outside of the U.S., and you have signing authority for checks for that bank. Even if you can't sign the check on your own, it has to be two signatures. If you're one of those signatures, it's reportable as well. So it is pretty encompassing, and it could also include, under certain circumstances, investment accounts or your foreign pension, depending on you have to look at the unique circumstances. So in other words, it could be a pretty wide net. And so it is something. And again, speak to your advisors, sit down, have that one-to-one in-depth conversation, and make sure that nothing gets left out, because the consequences could be pretty expensive, right?
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.